If you file your taxes as a C corporation, not only are you paying double the tax on the same income, you're actually paying triple the tax on the same income. And no accountant will ever tell you this. But in this video, I will show you how is it really that the C corporation is subject to triple taxation and how to avoid it and instead use a tax strategy to get out of the C corporation. So that you can understand it better, I'm also going to share with you a case study of our tax advisory client, Scott, who actually went through this. He had a C corporation paying the triple tax before he started working with us on his tax advisory, and now that he's not in that situation. Now, don't get me wrong, C corporation can be a great tax strategy to really reduce down your taxes, but you have to know when and how to use it. And this is exactly what we'll also cover in this video. Now, before we continue, a quick break. Hey, welcome to my whiteboard tax strategy. My name is Boris Musheyev. I'm a CPA and a tax strategist. Every Tuesday, I release a tax strategy video for business owners like yourselves to help you save money on taxes. So please go ahead and hit the subscribe button, the bell notification button. Please like this video if you really like it, share it, and check out the description below for more resources that I put together for business owners just like yourself. Now, let's get to my whiteboard for more tax strategy. Okay, cool. Let's get into this tax strategy. So how is it that C corporation really destroys you? Before we really understand it, let's talk about the basics. So the way I did it, I broke it down into 3 sections so it's easier to follow and easier for you to understand the business owner, right? So we're going to talk about the basics. Really, what is the C corporation and how is it really subject to double or even triple taxation? Then we're going to talk about case study about Scott. He's a construction business. He's our tax advisory client. He makes $2 million in gross revenue. We're going to talk about his situation, how he was a C corporation and how he used to work with the tax preparer. Look, if you have a tax preparer, you do not have a tax advisor, and I can guarantee you, you're overpaying in taxes. Don't be Scott. And we're going to talk about Scott. And we're also going to talk about a tax strategy that we used for him to get out of the C corporation situation that he has and how he's saving money on taxes. But at the same time, I will talk to you about how is it that you can use your C corporation to better assist you with your tax strategy and really tax savings. Awesome. Now let's talk about the basics of a C corporation. Now, C corporation, first of all, it's a separate entity, right? It is separate from you and it pays its own tax. That's really the biggest difference between C corporation and other entity types such as partnership LLCs, single member LLCs, or S corporations. C corporation is a separate entity and it pays its own taxes. Now, C corporations can have multiple multiple classes of stocks, right? I wrote it and forgot what I wrote. Multiple classes of stocks. Now, it's perfect for a scenario where you have outside investors, right? Generally speaking, when you have an S corporation, it's hard to bring in outside investors because S corporation can only have one class of stock. With a C corporation, you can have multiple classes of stocks and it attracts investors. Now, most small business owners don't really have investors in their business because they own a business 100% by themselves or with their spouse. So really, C corporation is made for bigger businesses. When you have more than 100 shareholders, publicly traded companies also are C corporations because they're required to be C corporations. Now, there are strategies when you can use C corporations. We're going to talk about it a little bit later, so make sure to stay on. But in this case, right here, a C corporation is also subject to double taxation because it pays its own tax. So I'll give you a very good example for you to understand. Let's say you buy an Apple stock on a stock market. Apple is an Apple corporation. It's a C corporation by default. It's a publicly traded company. It has more than 100 shareholders and more than one class of stock, right? Now, Apple pays 21% C corporation tax rate on its profits. At the same time, you're holding a stock, some ownership in that Apple corporation. They issue a dividend, whether they do it quarterly or annually or semi-annually, whatever that may be. You, as a shareholder of that stock, will pay tax on it again, right? Same profits that Apple is just distributing out to you for which it paid taxes, you're paying taxes. That is the case, a perfect case of double taxation. Now think about it this way. When you own your own business as a C corporation, you own 100% of your business, a C corp. You pay tax on that. At the same time, you take the distributions out to yourself, and guess what? you pay double the taxation again, both on the business side and on a personal side. Where's the triple taxation comes in from? Simple. Because remember, especially if you're an income tax state, your state is also taxing you on a C corporation. And then when you take the money out, your state is taxing you again on your personal taxes. Really, it's a triple taxation play. It destroys small businesses, that its main operating business is a C corporation. And you'll be surprised how many business owners that I speak to this date are still a C corporation without really knowing what is going on. Same thing with Scott. Scott had no idea. He's like, Boris, I have no idea why I'm C corporation or what I'm doing, but I know I'm paying too much taxes, right? So now C corporation does have its perks, meaning it has a lower tax bracket compared to an individual. C corporation is subject to 21% tax. What does that mean? Its profits are subject to 21% tax. Now, if you as an individual, are subject to a higher tax, 37% tax, meaning to say individuals in America, the highest tax bracket they are at, as of the day I'm shooting this video, is 37%. So there is, of course, a difference, and 16% difference. Now, C corporation is a great play in certain situations, not as for small business owners. We're going to talk about when C corporation is good, but really understand that C corporation is not made for small business owners, especially if it is your main operating business and you and your spouse own 100% of this business. So if you have a C corporation, you most likely would want to get out of it. And we're going to continue actually in this video talking about the case study. But before we do, a quick break. Hey, Boris Musheyev here. Sorry for the quick interruption. 5 seconds, I promise. I want to make sure you get your free PDF, 7 write-offs every S corporation business owner must know. The link to this free PDF is in the description below. That's it. Thank you so much. Continue watching. All right, awesome. Welcome back. Let's talk about the case study right here. Awesome. Now, here's the thing. With the case study, this is Scott, our client. He's a tax advisory client. He's in the construction. His gross revenue in his business is $2 million. We spoke on the phone, and then of course he signed up as a client. He's like, yeah, I want tax advisory, I want tax planning, I want tax strategy. I have no idea what I'm doing. Okay, great. So we went through his situation, and I'm going to give you like a high level overview, not going to get into details. I just want you to understand what is going on and the tax strategy that we used, okay? So now Scott has a gross revenue of $1.97 million, right? So almost $2 million. His net profit on that is $102,000. He's a C corporation. Let's follow through on this. He's gonna pay 21% tax on that C corporation. Excuse me, I'm moving around a lot, but 21% tax on that C corporation. That is $21,400. Bam, coming out of his pocket to the federal government for the purposes of him having $102,000 net profit. Follow me through on this. Now, he's in California. California is brutal when it comes to taxation. California has a C corporation tax rate of 8.84% on this income, on this situation. That's about $9,000. Bam, $9,000 coming out of his pocket again on $102,000 salary. Net profit. Now, that's already 30%, right? You're following me, right? This combined together is already 30%. Now, just sit down for this, right? On his personal income taxes, when he dips into $102,000 of the net profit and takes it out as a distribution, because he's an owner, 100% owner, he doesn't have investors to give it out to, this money is his money, right? He's going to pay combined between federal and state income taxes. I just combined it here for the lack of space. About $35,000 because California also being in the highest tax bracket. Now think about that. With $30,000 in business taxes, plus about $35,000 in personal taxes, that is $65,000 on $102,000 net profit. That is a 65% tax. Let that sink in. 65% tax. Do you know how many business owners in America are actually going through this, like Scott? Because they have a tax preparer, somebody who puts in the right numbers in the right boxes. You do not want to be in this situation. you definitely need to analyze why are you in a C corporation. Now, some businesses are required to be in S-corp, in a C corporation for other purposes, some compliance issues if they took out certain loans from their 401k, such as ROBs. Probably do another video on it some other time. But really, in most cases, if you're a business owner 100%, or you own it with your spouse, or even with a couple of your family members, being a C corporation is probably not a good idea for you. So definitely speak to your tax advisor about this. Now, let's move on to a tax strategy and really talk about, hey, what can I do today not to be in this situation? Or maybe I do need a C corporation, and how can I use the C corporation and be strategic about it? We'll be back right after this break. Hey, thank you so much for watching the video. Very quickly, if you don't mind, I want to ask for your help. I need your help. I want other business owners just like you that will benefit from a video like this to catch this video. The best thing that you can do for me, please either like the video or even say something in the comments, because that really helps the YouTube algorithm when it sees a lot of engagement to push the video to other business owners just like yourself. Or better yet, subscribe to the channel would be much appreciated. Thank you again. Now let's get back to the tax strategy. Okay, awesome. Ladies and gentlemen, let's talk about a tax strategy. Boom. C corporation, triple taxation. How can we avoid this tax strategy? And that is one of the ways to do it is elect an S corporation status. Now, what is an S corporation? I've got a bunch of videos and this will probably put some links here for you around this. But S corporation is just like a C corporation. It's a separate entity from its owners, so you get that liability protection. But S corporation does not pay business tax. There is no corporate tax rate. Everything that you earn in an S corporation will be passed through to you, the business owner, via K1. So Scott is now going to be filing his taxes in S corporation. No surprise. Scott will not pay, again, Scott will not pay $30,000 in C corporation taxes. He will not pay. He will pay about $40,000 in personal taxes because of his tax bracket and so forth. That is 20% less in his tax bracket. Why? Because he elected an S corporation status. Okay? He elected an S corporation status. Now, S corporation, again, it is not like C corporation. If you have investors in your business, especially in your startup and you're growing and you're going to be bringing in a lot of seed money, a lot of investors, S corporation is not the way to go in most cases. This is really for small business owners, husband and wife, just husband or a couple of family members, few $1,000,000 in revenue, few $100,000 in revenue, whatever that may be. We've seen obviously business owners who make tens of millions of dollars of revenue also be in an S corporation, which is totally fine, but they're the only owners. So they have elected an S corporation status. There is no business tax. All the profits is transferred, passed through to the owner. There's also something that's called a QBI, Qualified Business Income Tax Deduction. This is actually a gift from the IRS with the passing of the Tax Cuts and Jobs Act. Now, when President Trump became president, he passed the Tax Cuts and Jobs Act, and they slashed the corporate rate to 21%. And they're like, all right, we got to do something for small business owners that are not C corporations. So they gave what's called a QBI, which is a 20% deduction. To keep this simple and not to bore you with the formula, how it works, to simplify it, it's basically 20% deduction of your taxable income. If your taxable income for the year is, well, actually, I should take that back. It's a 20% deduction of the lower of your business income or your taxable income. Let's assume in this case, Scott has a business income of $102,000. Guess what? He's going to get additional $20,000 deduction, automatic deduction by the IRS on his tax form. But let me let you in a little bit of a secret. Your tax preparer, the one that puts in the right numbers in the right boxes, sometimes, unfortunately, forgets to check the box to give you this deduction. There are a number of returns that we have amended for our tax advisory clients when they came in from other accountants, because other accountants did not claim this deduction because they were too busy preparing returns. I don't know what the problem was, but they forgot to check the box. Every software is different. Some softwares do it automatically. Some you have to check off the boxes, right? So really, that's one of the strategies that we use for Scott. But can you really be a C corporation for a tax strategy purpose? The answer is absolutely yes. There has been situations where I have advised clients to be a C corporation. For example, this business is not your main operating business. That means it's not your bread and butter. That means you already have a main operating business, and that is your bread and butter, and that you can have it as an S corporation and have passed through, do all the deductions from it, your reasonable compensation, health insurance, retirement, whatever that may be. Then you've got a C corporation. You got to be strategic. Most businesses, when they have a second business, they're already getting strategic, right? That means their first business is doing well and they're investing in something. And it could be another business that you invested in, especially if you're a passive partner in that business, or you do not need to take the money out of that business. You might want to structure yourself as a C corporation. If the money is going to be reinvested back into the business or invested in other real estates under the C corporation, then you can take the money out as a loan. It's really outside the scope of this video right here. What I'm trying to get the message across is that you can be very strategic about a C corporation. There's different ways you can use your C corporation. We'll probably make another video just on C corporations, like on all of those strategies alone, how it can be, but it gets very tricky because it's not for everyone, and some people could misinterpret that. So I really have to think about if I will do a video on that, how I will structure that, because it's a tricky situation. C corporation can be a great strategy to pay 21% tax instead of 37%, especially if your profit in the business is about $1 million or more, right? You don't want to pay 37% tax. You want to pay 21% tax, but you've got to be very, very strategic about that. And you can't have your C corporation do that. You can't have your C corporation loan money to your other businesses or your other entities, but it's got to be reinvested through this business and have a purpose for this business. There's many things that we can talk about there, but again, the message that I'm trying to get across is that you can use a C corporation for that purpose. But what I want you to understand, if you are a small business owner, husband and wife, I don't care how much money you make, a few $100,000, a couple of $1 million, a couple of tens of millions of dollars, does not matter. If you're 100% owner of your business and you don't have any other requirements to say in a C corporation, which is is only for very, very few people, then you might want to think about the S corporation election and make sure you speak to your tax advisor. Thanks so much for watching. Hey, till the next time.